And what's interesting is to see that we'll call it the industrial or institutional side. So it's either large industry and or institutional investing.
You're watching Silver News Daily. Subscribe for more.
Silver is on the edge of a seismic event, one that could change the entire financial landscape. For years, experts have warned about supply constraints, but now the tipping point has arrived. David Morgan, one of the most respected names in the silver market, has issued a dire warning. A monumental silver supply shock is imminent. Physical shortages are worsening, industrial demand is exploding, and retail investors are at risk of being priced out completely. Think about it. Silver isn't just a monetary metal. It's a critical component of modern technology. Solar panels, electric vehicles, many medical devices, 5G infrastructure. Silver is the backbone of the future economy. Yet the world's supply is shrinking fast. Mining output is struggling to keep up, above-ground stockpiles are being drained, and institutions are quietly accumulating, while the average investor remains in the dark. The silver market is moving at a speed few are prepared for. Prices are already climbing, and once the reality of this supply crunch hits, it may be too late to secure physical silver at any reasonable price. Could we be standing at the beginning of the biggest silver rally in modern history? Stay with me, because what's happening right now could change everything you thought you knew about this market.
Well, we've had a great run last year, 2024, as you just said, and then it has certainly spilled over into 2025 so far, halfway through the month of February. And I was pretty accurate in 2024. I predicted about a 30% move in both metals, and that's approximately what we got, round numbers. This year, I kind of expect the same thing long term. So, 30% on top of, whatever number you choose at the end of the year for gold or silver. And you can take those numbers pretty much by forecast. So like 40 in silver as an example. I don't think it's going to trade at 40 and above, for half the year. I think we may see that print a few times. But coming back to your question, so far so good, strength. But I actually think we're overbought in gold, and all the sentiment is bullish. And I'm certainly thinking higher prices, as I just stated. But for the record, I think we could get a pullback here fairly soon. The reason for that is sentiment, technicals, and also there's a propensity in all the futures markets and all the commodities to resist round numbers. And a round number for gold is 3,000 USD. I know we're at 4,000 and beyond in Canadian dollars, and many other currencies were at all-time highs. But the dollar is the market that's watched by most. And that number of 3,000 may not be breached the first time through. It could, but I wouldn't be surprised to see a little bit of cooling off. Really, all the good news is sort of out there. I mean, as we discussed last time, we talked about what's going on in the London markets with fear of the tariffs, and then that spilt over into repatriation of gold, how much gold has moved from London into New York. And so that's where I'm at. I can be a contrarian within the contrarian community at times, and I guess that's where I am right now.
For years, the silver market has been quietly approaching a crisis, and now the cracks are turning into fractures. The signs have been there: declining mining production, vanishing stockpiles, and surging demand. But the mainstream financial world has largely ignored them. Why? Because silver has always been treated as a second-tier asset, overshadowed by gold and dismissed as just another commodity. But that's about to change in a big way. The reality is this: silver is running out. According to multiple industry reports, global silver production has been struggling to keep pace with demand for years, and the deficits are only getting worse. We've now entered a period where the world is consuming more silver than it can produce. Above-ground stockpiles, the reserves that have historically acted as a buffer, are rapidly depleting, with major refiners and suppliers reporting historic lows in available inventory. This isn't just a temporary blip, it's a structural shift. Mines are shutting down due to declining ore grades and rising costs, and new discoveries simply aren't coming online fast enough to fill the gap. Silver isn't like gold. It's mined primarily as a byproduct of other metals like copper and zinc, which means that even if silver prices skyrocket, mining output won't suddenly surge to meet demand. Yet despite all of this, silver prices have remained artificially suppressed until now. The supply chain is tightening, and the moment industrial users realize just how severe this shortage is, there won't be enough silver left for retail investors. And when that tipping point is reached, silver prices won't just rise, they'll explode.
Yeah, you really said it, Elijah. I'll just elaborate a bit. So there's really two markets. When I say the silver market or the gold market, I'm talking about the derivatives market, which is the price set by the COMEX. And even though it's a price of a derivative, all of the prices gear off of that price. So in the retail market, that's a separate market from the futures markets. And that market, which is substantive, does not set the price in the futures arena. The futures arena sets the price in the retail market. So if the retail market is very tight, then you will see huge premiums like we saw not that long ago. I mean, Miles Franklin and on all the dealers were selling silver eagles at, I think at one time, like a $14 premium or something, because that particular market was extremely tight. Lots more buying than selling. Now we have the opposite. Most of the retail market, it's you and I, it's the stackers, it's individuals that buy silver and gold, have basically got all they want, or they've got to pay a bill, or they've given up, or any combination of reasons. And they're being net sellers, basically, and there aren't much buying in that realm. On the other hand, when you look at the derivatives market, which usually isn't used as a delivery mechanism, it has been. You've been seeing the silver moving out of the SLV as an example, silver moving again from London, New York, and then delivery taken out of New York. We've seen a lot of movement in the physical in that market, meaning 1,000-ounce commercial bar market in silver and the kilo bar, 100-ounce bar market in New York and London usually has 400-ounce bars, which could be converted to 100-ounce bars. So regardless, it's something that's very different. Most of the time we're really, even though we use the word silver, we're talking about the retail silver market. But really, I mean at all times the derivatives market. Same thing with gold. And this is the distinction between the two. And what's interesting is to see that we'll call it the industrial or institutional side. So it's either large industry and or institutional investing is driving the market. And that's really the purpose of the futures market. So we're really in a place that's kind of where it started out, meaning that instead of the tail wagging the dog.
Silver isn't just a precious metal, it's an industrial necessity. And right now, industrial demand is accelerating at a rate the market simply isn't prepared for. The world is moving toward a future dominated by green energy, advanced technology, and electrification, and silver sits at the center of it all. Unlike gold, which is mostly hoarded by investors and central banks, silver is constantly being consumed, often in ways that make it impossible to recover. Let's talk numbers. The solar industry alone accounted for nearly 140 million ounces of silver demand last year, a number that's only expected to climb. Governments around the world are pouring billions into renewable energy projects, and solar panel production is surging. The problem? Each panel requires silver, and there are no viable substitutes. As global energy policies push toward net zero carbon emissions, demand for silver and solar technology is set to skyrocket. And it's not just solar. The electric vehicle revolution is in full swing, with automakers committing to full electrification within the next decade. Silver is embedded in every EV, from battery connections to charging stations, and demand from this sector alone is forecasted to explode. Add in 5G networks, medical technology, and AI-driven computing, and you start to see the bigger picture. Industrial demand is climbing exponentially, and the supply simply isn't there to match it. This is where the crisis deepens. Unlike gold, which is rarely lost after being refined, silver is used in products that are often discarded, with little to no effort made to recover it. This means that once silver is consumed, it's gone. And with more silver being devoured by industry every year, the question isn't just whether there will be enough for investors, it's whether there will be enough for industry itself. At some point, industrial users are going to wake up to this reality. And when they do, they won't be waiting for silver to trickle down through the normal supply chains. They'll be racing to secure as much of it as possible. When that moment arrives, the retail market could be locked out completely, and silver's price could erupt in ways few are prepared for.
silver has been disappointing. I mean, if we look no further than the gold silver ratio, that tells us the story. And because gold has made so many nominal new highs and silver has not, and the gold silver ratio is well above 80, that's just suggesting that, silver's lagging, and it is. I think it's not only has it underperformed, say maybe last year where it's been a little bit better than gold, but I do think it'll catch up. I mean, it's not untypical for silver to fall behind, let's say, gold's lead, and all of a sudden it takes off and it definitely catches up and overpowers gold on a percentage basis. That's what I do think will happen. I'm not sure it'll actually happen this year, although it could. I do think that this year silver will outperform gold, but not in a real substantive way. So, for example, if we got the gold silver ratio to 70 this year from, well above 80 right now, I would consider that a win. I started the Silver Investor website and, rebranded the Morgan Report many, many years ago. But at the time I started the first website, the gold silver ratio is about 80 even. And really, Elijah, at that time, I thought that would be the highest gold silver ratio that I would see from the year 1999, 1998 when I started the website until present. Obviously, I would have been wrong. We've seen well over that, not only recently with gold making new highs, but you go back to when the illness broke out in March of 2020, and we saw really, for my records and many others, probably the all-time high gold-silver ratio, which is over 125 to 1. It didn't last very long. It was a spike. I actually was lucky enough to buy silver within a few days of that actual high gold-silver ratio, meaning you were getting, a lot of silver for your gold if you were swapping, or a lot of silver for your fiat at the time. Point I'm making is no one knows more than the market. But even though it looks rather bleak, and I'm disappointed as many silver investors, the game isn't over. The end game isn't here. And silver is a very tight and very small market, and it's able to move up and down faster than the gold market. So I probably said enough, but I do think that if you're disappointed, it wouldn't be the time to sell now. I think going forward, silver from this point forward will outperform gold, maybe not on a daily basis or even a weekly basis, but on a monthly basis and on the broad market basis, wherever we end up on the highs of these markets in terms of US dollars. I think once that's achieved, you can see a gold silver ratio probably at least about 30 to 1. The reason I say that is that we've already been to 33 to 1 gold silver ratio when we had the financial crisis of 2008 and silver got below $9 and it went up 550%. It went from under $9 to roughly $50. Gold did a little better than a double, if I recall correctly. So silver certainly outperformed gold in that move. And I think we're going to re-witness something like that again.
For decades, the silver market has been manipulated, controlled, and suppressed, but that suppression is now reaching a breaking point. At the heart of this lies the silver futures market, where massive short positions have artificially kept prices lower than where supply and demand should dictate. But what happens when the physical market tightens so much that those paper contracts can no longer be covered? A short squeeze of historic proportions. To understand the scale of this potential squeeze, we need to look at the silver futures market itself. Large financial institutions, particularly a handful of major banks, have built up massive short positions in silver, betting that prices will stay low. These shorts act as a tool to suppress price action, discouraging investors and keeping industrial users from panicking about supply constraints. But here's where it gets dangerous for these short sellers. When physical silver inventories run dry, they'll be forced to deliver metal they simply don't have. Normally, they can kick the can down the road, rolling over contracts or settling in cash. But if the industrial sector starts competing with investors for physical silver, that entire game unravels. The moment a major institution gets caught in a short squeeze, forced to buy silver at any price to cover its obligations, the floodgates will open. And history proves just how violent a silver short squeeze can be. In 1980, when the Hunt brothers attempted to corner the silver market, Prices spiked from under $6 to nearly $50 in just a few months. In 2011, when silver started breaking free from manipulation, it surged from $9 to almost $50 again. But this time, the setup is even more extreme. The supply shortages are deeper, the demand is higher, and the short positions are even larger. The moment the physical market exposes the weakness of paper silver, the price suppression will break. And when it does, silver won't just climb, it could go vertical. Institutions that spent years betting against silver will be scrambling to get their hands on real metal, and when that happens, we could witness one of the most explosive price surges in history.
Well, both. I think this tariffs is definitely what started the run to gold. And there's an arbitrage opportunity where you have a differential between London and New York. So if you're going to cover your short and you have the physical metal there, you have to have it shipped in order to accomplish that. And that's what's been taking place. Will we get a big rollover in the subsequent months? Yeah, I think we will. We've seen this happen a few times before, not to this level, at least to my recollection, but usually everyone gets very excited. Everybody gets on one side of the boat. And then as the days and weeks roll by, it subsides. I think that's probably the most likely case, but it's yet to be determined. Further, the gold markets is a much more vast market than the silver market. It's deeper. And you've got a lot of central bank holdings. So let's say for an example, or as a thought experiment, there was a bullion bank that was behind the eight ball, so to speak, and they needed a delivery. It wouldn't be surprising at all to see a swap take place with the central bank, take the physical gold, put it into place so there's no, problems, and then that swap will later be paid back either in paper or metal itself. I'm not saying that that's a given, but it's certainly happened in the past and certainly could happen in the future. And because, again, gold market is pretty deep, you have a better opportunity for that to take place than you would in the silver market. But regardless, both of those markets do have, let's say, a tight-knit community that can work together at times.
The gold-to-silver ratio is one of the most overlooked yet powerful indicators of silver's future price action. And right now, it's flashing a signal that could mean an explosive move is coming. Historically, whenever this ratio reaches extreme levels, silver follows with a massive price surge, and today, we're sitting at one of the most extreme readings in decades. Let's break it down. The gold-to-silver ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. For most of history, this ratio has hovered between 15.1 and 40.1, meaning silver has historically been priced much closer to gold. But in recent years, that ratio has been stretched beyond anything we've seen before, climbing as high as 80.1, 90.1, and even over 101 at certain points. What does this tell us? When the ratio reaches these extreme levels, it's a sign that silver is severely undervalued relative to gold. And every time in history that the ratio has collapsed, silver has gone on to deliver massive gains. In the early 1980s, when silver rocketed to 50s, the gold-to-silver ratio plunged from 40.1 to nearly 15.1. In 2011, when silver surged past $40 again, the ratio collapsed from over 80.1 to below 35.1. And today, we're sitting at one of the highest ratios in history, signaling that silver is once again poised for a major revaluation. The setup is undeniable. Gold has already confirmed its secular bull market, breaking all-time highs, and historically, silver lags before making its move. Once the market catches on, once investors realize that silver is trading at a fraction of its real value, we could see a rapid repricing that sends silver to new all-time highs. The gold-to-silver ratio isn't just a number on a chart. It's a warning sign for those paying attention. Every time this ratio has hit extremes, silver has responded with a surge that left most investors in disbelief. The question is, will you be ahead of the move, or will you be chasing it when it's too late?
Absolutely. Let's add on to that. I mean, this is getting into the minutia, but I think it's important to know. I mean, I did one too where I actually got more for a kilo bar than I would have for coins. That's insane. It takes a lot more energy, power, time, and energy to produce a 1 ounce coin than a kilo bar. And yet, under these circumstances, similar to what you just said. So if you're very tuned into the market, and I don't talk to Andy all that often anymore, but I do talk to several dealers on a weekly basis. And these are opportunities that if you're so inclined, you want to take advantage of. I mean, if you can get a semi-rare, 1933 gold coin for the same as a gold wafer, why not? I mean, I'm not saying to swap all your gold wafers for, earlier gold coins, but certainly worth considering because the premiums usually stabilize. When they get out of whack like they are now, that's the time to take action. And then when I go back into normal premiums, those 1933 coins will have a larger premium than a gold wafer. It's just the market gets these distortions as we're discussing. The other one real quick is the bag market. I mean, usually a junk bag or constitutional silver sells at melt or a slight discount. That's what you can buy it for in many cases. But in certain instances where people are really worried about the barter value of silver, such as Y2K, for example, I think a 40% premium on bags. And that's where you should swap your bags into silver bars, for example. So these anomalies do come up within the market itself that you can take advantage of.
Retail investors are walking straight into a trap, and most don't even realize it. The silver market is tightening at an unprecedented pace, but by the time the average investor wakes up to what's happening, it may already be too late. The reality is this: small investors are at serious risk of being priced out completely as institutions and industrial users rush to secure physical silver. Here's why. The silver market operates on two levels: the paper market, where contracts are traded back and forth with no real metal changing hands, and the physical market, where real silver bars, coins, and rounds are bought and sold. For years, the paper market has dominated, keeping prices artificially low. But when supply tightens, the physical market starts to take control, and that's exactly what we're seeing now. Premiums on physical silver are already skyrocketing. Even when the spot price appears stable, retail investors are paying record-high premiums just to get their hands on silver. And this is just the beginning. Once industrial users realize they can't secure the silver they need, they'll move aggressively into the physical market, sweeping up whatever inventory is left. At that point, premiums won't just be high, they'll be out of reach for the average investor. And we've seen this play out before. In early 2021, when the silver squeeze movement took off, premiums exploded. Physical silver disappeared from dealer shelves, and anyone who hesitated found themselves paying 50%, even 100% over spot price. That was just a taste of what's coming. This time, it won't be a temporary squeeze. It will be a systemic shortage, and once it hits, small investors will have no way in. By the time silver's price truly reflects its scarcity, most investors will be watching from the sidelines, unable to buy at any reasonable price. The question isn't just whether silver will go up, it's whether you'll even be able to get any when it does.
Yeah, if you've never exposed yourself to having, physical metal, there's never a wrong time to buy. Really, there isn't, because it's the money of last resort. And if there's so many scenarios and they're all rather bleak, but they're all fairly realistic. If you have a power outage, if you have a food shortage, if you want to go to the farmer's market or whatever, silver is the money of last resort as far as the people are concerned. You could use it as money or as a barter item if you want to think of it in those terms. And there's a certain amount that's kind of right for everybody, but you certainly don't need to put your life savings into the precious metals. On the other hand, if you don't have any, you're kind of not covering all your bases. You're not really prepared for a financial situation. It wouldn't necessarily mean bank closures or the gold market freezes up or anything along those lines. Something more of like, maybe a weather event that we've seen several of in this country and around the world. So something I think everyone should own a little. And that's the amount little is an individual choice. One silver coin probably isn't going to do a lot for you, but so you have to kind of use some common sense. So I think that's step one. If you don't have any, you certainly want to consider it now, and then no matter what the price. If you're already in the market, then I think just, if you have enough holdings, all you need to do. And then if there's a shift in the premiums, you might take a look at it. And if you're fairly sophisticated, you might look at the gold silver ratio. Say, wait a minute, I've been a gold bug the whole time. Is silver so undervalued? Maybe I'm going to swap some of this gold into silver, that type of thing. But it's again, individual choice. There isn't one size fits all. guidance I gave you is pretty sound, basically common sense.
While retail investors hesitate, the biggest players in the financial world are making their move. Central banks, governments, and billionaire investors aren't waiting for silver to explode. They're accumulating now, quietly pulling supply off the market while the average investor remains distracted. By the time most people realize what's happening, the game will already be over. For years, central banks have been hoarding gold, but here's what they won't tell you: silver is just as critical. Historically, governments have used silver as real money, and with global currencies weakening, the demand for hard assets is only increasing. Some of the biggest sovereign wealth funds and institutions are now acquiring silver, yet they're doing it in a way that avoids attracting attention. Then there are the billionaires. Unlike retail investors, they aren't buying silver coins or small bars. They're purchasing entire vaults worth of metal, securing their positions before the masses catch on. Some of the world's wealthiest investors, from hedge fund managers to industrial tycoons, have been shifting capital into silver, seeing the same supply crunch that's about to unfold. But here's the key. When central banks and billionaires buy silver, they don't sell it back into the market. This isn't like stocks or crypto where a quick profit is the goal. They're acquiring silver for protection, for wealth preservation, and in some cases, for strategic industrial use. That means the available supply isn't just shrinking, it's disappearing completely. This leaves the average investor in a dangerous position. When silver truly breaks out, it won't be because retail traders suddenly start buying. It will be because the institutions have already taken control of the market. And when that moment comes, the retail crowd won't be getting in at today's prices. They'll be fighting over what little remains at prices most never thought possible.
Or I would take a deep breath and go back to what I said on the previous question, that I've seen this before, and usually as we get closer and closer and we get more and more, interested in what's going to take place, it usually blows over and goes back to the normal configuration. The thing to watch for is very easy to spot, and that is the spot market, the cash on demand market. So basically what happens when you need a commodity like wheat or corn or silver, and you need it now, then we get what's called backwardation. So if silver's at $33 the ounce, if you have to have it like tomorrow, the price could be $33.50, for example. And then the next month out, it'll be at 33, which is inverse to the contango. Usually, all commodities go in contango, which simply means basically it's usually like the 10-year rate. So whatever that interest rate is applied in the following months. So a year out, it's 6% higher. That's general rule of thumb. The point being is a futures contract costs more the further out in time that you go. But if you need it really badly, it goes backward, meaning you pay more now than you do in the future. So that becomes a cash market, the spot market. I need it on this spot now. So if that were to occur and it happened for one day, that's no big deal. 2 days, no big deal. 3 days, no big deal. But if it went for, let's say, 2 or 3 weeks in a row, now the market has really turned into a cash market only. The futures market certainly would have some power. It would have some meaning. It would probably be used for hedging, but it would turn into basically a cash market. If I need this metal now and I'm paying cash on the barrelhead now, I need delivery now, that would be the price that would be setting the standard from that point until it ended. In almost all commodities, whenever that's taken place, it only lasts for a short amount of time. The amount of the commodity, be it soybean oil or wheat or silver, subsides once the demand that's more than normal is satisfied. Then we go back into contango. The months go, the backwardation ends, and things go on as normal. But that's the thing to watch. That would be the absolute proof that the market is distorted. So, the market is recognizing that silver for the delivery right now is extremely hard to find. And because of that, you have to pay a premium again. I do think that at some point, and I've said it for years and years, that there would be a point where the physical market takes precedence over all the derivatives markets. And certainly in a small scale, that is what's happening. But I'd call it a small scale because we just haven't seen it Not so much in quantity, because quantities moved out of London have been rather substantive, but not in time duration or the backwardation that I'm referring to in a way that's absolutely crystal clear. It's not yet.
With all of these forces colliding, historic shortages, industrial demand surging, short sellers on the brink, and billionaires accumulating, one question remains: how high can silver actually go? While no one can predict the exact peak, history and market fundamentals give us a clear picture of where silver prices could be headed. Let's start with the conservative estimates. Based on the trajectory of past silver bull markets, analysts predict silver could reach 49 by 2025, consolidate around 50 in 2026, and then push towards $70 by 2027. By 2030, some projections place silver at $82 per ounce. But these estimates don't factor in the full extent of the coming supply crunch, or the potential for a financial panic that sends investors rushing into hard assets. Now, let's talk about the aggressive scenarios. If silver follows the same explosive pattern it did in 1980 and 2011, a move beyond $100 per ounce isn't just possible, it's entirely plausible. Some experts argue that when adjusted for inflation, silver's true peak in today's dollars would be closer to 150. And if a true supply crisis emerges, where industrial users and investors compete for dwindling physical metal, silver could go even higher. But here's the part most people don't understand. Silver's price isn't just about supply and demand. It's about confidence in the financial system. If investors lose trust in paper money, if inflation spirals out of control, if central banks continue to devalue fiat currencies, silver becomes more than a commodity. It becomes real money. And when that shift happens, traditional price targets go out the window. The window to act is closing fast. If silver breaks through key resistance levels, $30, then $50, it could trigger a buying frenzy unlike anything we've seen before. Those waiting for confirmation might find themselves chasing silver at prices they never imagined possible. The question is, will you be positioned before the breakout, or will you be scrambling when it's already too late?
And the derivatives price determining how much silver ebbs and flows. We're in a position now where the actual physical market, at least greater than normal, is setting the price out there. And that's why you're seeing this arbitrage opportunity and potential for backwardation, where you have to pay more at spot price at today's price than you would in the near futures, because it's demanded right now. And so it's very interesting to watch this unfold, Elijah, because that's the true market. And if that market were to break, then it would be most interesting to see what the authority figures would actually do. Technically, and for the record, you can never default on the COMEX. The reason being is the contract says that a cash settlement is final settlement. So for an example, someone stood for delivery and they were given a check and said on metal, 1,000-ounce bars. There's nothing you could do about it. You've already agreed when you signed your futures contract, be you, a speculator or a large institution, regardless of the same contract, the same rules apply, and you couldn't whine, cry, or do much about it. You might post it on the web and say, hey, I wanted to stand for delivery, but I got a check instead. But if you know how the market works and what the rules are, you kind of have to blow it off and say, well, you're the one that knows you're going to get paid one way or the other. And then that's it. Now, I would say there's exceptions to that, but if someone demanded delivery through a refinery, for example, which is a hard contract for physical and physical only that was outside of the futures market, be it either the over-the-counter market that's opaque and no one really knows about it. I didn't know about it, but we don't really know all the details, or the COMEX, which is very transparent. At least they publish all the numbers, whether you believe them or not, they're published. And that market, you can make a determination based on a non-delivery, for example.
The silver supply shock isn't some distant possibility. It's unfolding right now. The cracks are already visible. Shortages are worsening. Industrial demand is accelerating. Short sellers are on borrowed time. And the biggest players in finance are quietly locking up supply. Everything points to one inevitable conclusion. When silver finally breaks free, it won't be a gradual rise. It will be a historic eruption, leaving unprepared investors scrambling. Retail investors who hesitate risk being priced out completely. We've seen this story before. Once silver moves, it moves fast, and those sitting on the sidelines will be watching as premiums soar and physical silver disappears from the market. While mainstream media ignores the crisis, those paying attention know what's coming. The financial world is shifting, and silver is about to play a leading role. The choice is clear: prepare now or risk missing one of the most explosive moves in silver's history. And as always, this is not financial advice. Do your own research, consult a professional, and make informed decisions. The silver market is waking up. The only question left is, will you be ready?